critically important that we look at some charts that will give us a longer term perspective, especially considering that today, October 19th, we had a dramatic reversal with some gapped pricing. Boy, I hope you can forgive me. I've got a tremendous rainstorm going outside, but I really want to get this message across. We've had a big reversal here, some gaps in the opposite direction of the trends. The dollar jumped up, silver jumped down, gold went down, markets went down, stock markets went down. You know, a lot of energy had to be poured in to create these reversals, but it doesn't mean we've got reversal of trends. It doesn't mean we've established an uptrend for the dollar or a downtrend for silver. That could happen this week. We could see that, but right now, tonight, we don't have that. But what we do have in a longer term is some charts to look at. And I want to start by looking at the total U.S. debt by fiscal year. October through September 30th, 1950, through September 30th, 2010. This is a chart that's provided by BabylonToday.com, a very curious and interesting website, but this is a chart they provided. And you can see that the period around the turn of the century, meaning the turn of this most recent century, produced increased capital gains revenue from the booked sales of assets inflated by mass Fed F3 money stock growth and easy credit. It fueled the greatest asset mania in our nation's history. We had this tremendous real estate expansion. Everybody was buying homes and making gains in homes. And it was inflationary, there's no question about it, because if nothing else, the price of homes were rising tremendously. Sure, gas and food may have stayed the same, but housing prices went nuts. So, what we see here, and this is where we have to really get realistic, around 1997-98, you see there's a little flat plateau there where the two arrows are. Around 600 billion, 6,000 billion, is that what that is? Dollars, which I take to be $6 trillion, flattens out. 2000 hits, and I will point out to you Republicans that 2000 is George Bush. And look at that climb. Look at that climb. And as of September 30th, 2009, we're at $11.9 trillion in fiscal debt, U.S. debt. And, okay, follow this now. 1 year later, September 30th, 2010, we're at $13.561 trillion in debt. That rate of growth in debt is extraordinarily dangerous and obviously unprecedented, and we're just climbing on these charts like you can't believe. If we normalize this chart to get these red lines down into here, it would make 1950 look like we didn't have any debt at all. Very, very dangerous stuff for the country to be running that kind of debt. I want to jump over real quickly and look at the annual consumer inflation CPI, and I want you to look at this. Look at where these numbers are. Okay, this is your inflation. Government versus SGS alternate. This comes from Shadow Stats, and this is the difference between the official inflation and the alternate CPI. The official inflation simply takes things out of the basket if they start to get too pricey, and so it is a skewed number. But the real number is still up there. Yes, we've had some period down around the 5%. We bounce up and down towards the 10%, but that's still a lot of inflation taken over a long period of time. Let's not forget that. So we don't have to have hyperinflation to have a dramatic impact of inflation. At 10% inflation cuts your money in half every 7 years. Correct me if I'm wrong, mathematicians, but I believe that's the case. So not a good proposition, even in the best of circumstances. And remember that the Fed is now talking about inflation as being one of their possible selection tools. Okay, I want to look at the continuous contract gold EOD index. This is from stockcharts.com. Pretty self-explanatory. You can see back in 2001 it was at $250 or so, and you really have to make yourself think about what the heck we were thinking to not buy more gold at that point in time. But there's that chart. Very regular, very advanced, almost unprecedented. It's a giant picture that looks very much like the current run-up in silver or gold. So it's bullish. It tells you a lot. Compare it with the fiscal debt chart, and it looks to me like there's an even steeper climb ahead, potentially here. Looking at here is unemployment. The unemployment proposition. This is really lovely. The official unemployment rate of U3 is here, and you can see how it's traversed along below and above 5%, and kind of made this climb since the presidency of Barack Obama came into play. It shot up here and is now officially around this just below 10%-ish kind of number. Marvelous. The broadest, U6. What U6 represents is that's the people who are no longer eligible for unemployment because they've been unemployed for so long that they're off the unemployment rolls. And then we just add back in the unemployed people, and we find out that we've got at the present time 15 to 17% unemployment. SGS alternate, another measure of what the real unemployment picture is, and you can see that that has us well over 20% unemployment. I think that it's very reasonable to use U6 as the real level of unemployment, and we can debate SGS alternate some other time. But that's the picture there. So look at the unemployment climbing, look at the national debt climbing, look at the rate of gold climbing, and look at the rate of inflation climbing. Did I get all four of those right? They're all climbing. That's the future. That's what we have to deal with. The real negative part of this is that we have an economy that stinks. If we had some vibrancy in the economy, we could at least have some blood flowing through the veins of the system. But with the blood creeping to a halt and these things going on, we have some real serious problems. Time to fine-tune our plans, probably invest in silver and gold being the best kinds of defensive positions, but I am certainly open to suggestions because real estate is likely to go deflationary for some continued period of time longer, and I think gold and silver are bound to go inflationary for some period of time longer. But predicting the future is very difficult and very hard, and we don't do that, which is why we only do these little chats for fun. They are not investment advice. I hope some of you can come up with some ideas that will help us get even better choices here. So thank you for listening.